Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With the news of Trudeau resigning, there are developments in the tax scene that deserve some attention. And we do have some breaking news to share with you on that front. First, we're going to be speaking with Denise Chisholm as scheduled, and then we'll give you a bit of an update on specific tax implications in light of recent political events. So that comes a bit later. But now let's get to today's show. The U.S. 10-year yield has hit an 8-month high and is uninverted for the first time in a couple of years. And our next guest says that while there isn't a clear picture on what a steepened yield curve might mean for stocks and for overall returns, it does hold information for sectors, which sectors ultimately could be poised for gains amid a steeper curve. And could it ease the inflation concerns overall? Joining us now to unpack all of this and more is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise. Great to have you here. How are you?
Hi, Pamela. It's great to be back. Happy New Year.
Happy New Year to you as well. And let's begin a little bit with the idea that a yield curve usually gives you the direction of the economy, or it kind of does. And there have been changes there. So what is the new direction?
Yeah, so we saw the most aggressive steepening that we have seen in, I want to say, the better part of 5 to 7 years. So it's a top decile steepening, even in the belly of the curve, or twos. I'm using it twos minus fives. If you want to look at charts of the week, if you find me on LinkedIn, you can look at all the charts that I'm basically going to talk through right now. And it's interesting. So the belly of the curve was the last to uninvert this cycle, but it uninverted at a very rapid pace. So if you say, okay, does that give you any sort of insight into what happens to the market? There's been a lot of debate on rapid rise in the yield curve is a sign that you're potentially entering recession because the Fed's cutting aggressively. It's very inconsistent historically. This one time in 2001, where a very rapid ascent in the yield curve did lead to outsized losses in the equity market, pretty much in every quartile of the prior 6-month change. Remember, we're a top decile 6-month change in terms of the yield curve, leads to the same odds of a market advance, which is about 80%, and the same average market returns. So there's not a ton of information content in the yield curve. And that's true historically speaking. I mean, we've talked about this as well, like the inversion of the yield curve being a great timing in hindsight of recessions, but never a great timing indicator, because even an inversion can be somewhere between 6 months and 4 years ultimately when you see the recession, right? Everybody always forgets about 1966 when we saw a yield curve inversion, but we never saw the recession until 1970. So I'm not a big proponent of using the yield curve as to, hey, what's going on in the economy? Is that a forward look? What's going on in stocks? Is that a forward look? I think it's sometimes yes, sometimes no. Really, there's not a ton of signal in it, but there is a ton of signal, to your point, about sectors and which sectors you'd like to own.
Okay, well, let's go into that, because if you've got less of a chance of recession, in theory, you would be loading up less on the defensive nature of how you would protect one's portfolio, and you might lean into the risk. Let's go to why you might lean into the risk, some of the reasons why you could, and then go to the sectors ultimately. But it seems like you have some good things at your back at this point.
Yes, I do think that that's the case, especially on economically sensitive sectors like consumer discretionary and financials, which are probably at the top of my interest level, just from a risk reward perspective. And there are a lot of good things that I see in the data. Let's talk about the durability of earnings growth overall, which usually as an investor gives you a pretty pro-cyclical bend. So we started talking about interest rates, and I think that there's still the narrative out there with the higher interest rates are, maybe the more likely it is the market contracts, because that's a potential headwind. But what we've seen over the last 2 years is that hasn't been the case. And when you look at all the historical data, there's actually a positive correlation between higher real rates and higher future growth. So in some ways, you don't need to be as afraid or think that there is a very critical driver in rates, because the more important critical driver is earnings growth. And what I've seen in my database is we actually have an inflection in earnings revisions that's now at top decile levels from a change over the last 6 months that does usually lead stronger earnings growth over the better part of the next year. And typically, earnings cycles actually last a lot longer than you might think from an investor perspective. A typical earnings growth cycle is about 3.5 years, some of them lasting as long as 5 to 6. We just saw our contraction, which I would argue refreshes the ability for earnings growth to stay durable in 2022, 2023. So we're really in the very early stages of a durable earnings recovery. That's data point number one, pointing you as an investor towards those economically sensitive sectors because earnings growth is more durable. But point number two, specifically for consumer discretionary, which is the main sector tied to the steepening of the yield curve, is that back at valuation support. And I think that that's really important. So free cash flow has been so rapid this cycle that really all the underperformance that we've seen in consumer discretionary versus the S&P 500, which has been in fits and starts, but it hasn't been a solid outperformer, certainly through the beginning half of last year. All of that you saw derating in the stocks. So all of that underperformance was the stocks getting cheaper and cheaper on a relative basis. So now your starting point as we enter 2025 is a pretty good situation for valuation support. So when the stocks are more expensive on free cash flow yield, they haven't generally on average underperform. And when they're in the bottom quartile, where we are right now of free cash flow yield, they have 70 above percent odds of outperformance with 800 basis points of average outperformance. So your starting point on valuation is a positive risk reward, plus the fact that the yield curve is a really good indicator, plus the fact that earnings growth has been solid this cycle, in addition to the potential tailwinds we're still seeing with crude oil coming down and interest rates coming down as well, specifically at the short end. So I think your risk reward as we enter 2025 is that those economically sensitive sectors continue to lead higher.
It's sort of amazing because the valuation story for consumer discretionary, I mean, their valuations were off the charts in certain sectors throughout last year. Consumer discretionary needs to catch up, or can catch up, I guess is the point. And you've pointed to the durability of it going forward. Is there much that could knock it from its spot at the top there?
I mean, what's interesting about valuation support is you say, okay, Denise, you get the earnings story wrong. Earnings aren't as robust as you think, and earnings growth actually contracts in 2025. What if I look at that contraction? I have perfect foresight now with the conjunction with starting points on valuation being at this advantageous level. That's still higher odds of outperformance, like 70% odds, with even sometimes more average outperformance, because that's usually around troughs. So the point being behind the mathematical exercise is really valuation provides a really solid risk reward regardless of earnings growth.
Right.
And I think that that's the interesting part about valuation when it's predictive, is that it changes your risk reward. So I don't necessarily need to get earnings growth right, but my downside risk is fairly limited, with my upside risk potentially more skewed. So I think that that's the interesting part that I'm seeing as we enter 2025.
I mean, it sounds like an argument for value stocks to an extent.
It can. So it depends on which value stocks you're talking about. I mean, some consumer discretionary stocks land in value. Financial stocks definitely land in value. And I am constructive on financial stocks. But some value stocks are in energy, and I'm not constructive there. So in some ways, I think that, as much as we argue about is it going to be value or growth, certainly it depends on the cap that you're looking at, because the higher up the cap spectrum you go, the more dominant growth has been over the course of the last year. But when you look at small and mid cap value has actually been better than small and mid cap growth over the course of the last, let's call it year, 18 months. So the growth dominance has been really only in the large cap indices. So I do think that that's important to talk about, because I think that that's a more neutral risk reward, value versus growth, when you look outside that framework.
Okay, so go into the cap spectrum first. You mentioned small caps. We mentioned what they've tried to do a couple of times last year, actually. They caught a bid and then got bounced. So that might be an interesting setup going forward with an uninverted yield curve as well.
Yes. So I do think all the drivers, this hasn't worked so far. All the drivers are still there, right? The Federal Reserve cutting interest rates, 100 basis points of cuts that we've seen is a top quartile cutting when you look historically. That usually leads to 75% odds of small caps outperforming. And I think usually the way that the translation mechanism works is lower interest rates create the odds of multiple expansion, which are already at an advantageous part of. So in terms of earnings growth, those dual tailwinds that we talked about, crude coming down and interest rates coming down in the short end, usually do spur together small cap earnings growth. And we have not seen that acceleration yet, but I do think that there is an increasing potential to see that in 2025. Now, what's really interesting about the small cap story is it has been in fits and starts. And what you saw in December was a very small correction in the overall S&P 500, a bigger correction in small caps. What you saw on my data set that I'm about to put out in charts of the week was another spike of those valuation spreads. So if you're worried about tariffs, if you're worried about inflation, if you're worried about the term premium, and if this is like a debt problem in the United States, I will tell you that all of the indicators that I look at quantitatively are now back to that top quartile level. So price to book valuation spreads in the Russell 3000 is back to top quartile levels. That once again skews your odds towards the upside in the Russell 3000, which let's talk about that from a cap perspective. So as much as it was a blow in the sense that small caps didn't continue their outperformance, your starting point is now better than it was 3 months ago. So it almost comes back to that math behind that we were just talking about of consumer discretionary. Look, I think the downside is limited. And we haven't seen the upside yet, but I think your risk reward is still skewed positive as we enter 2025.
This is absolutely fascinating. I have to ask your thoughts on the Fed minutes and what was discussed before the decision that was made in December. There, the communications that we saw in the press conference and so on was that there was a reticence to, step in before policy was made by a new administration, basically.
Right. No, I think that some of their expectations baked in some level of tariff expectations. And as much as, for the most part, the Federal Reserve, certainly Chair Powell, has said that they weren't going to bake in or presume what political outcomes could lead in terms of inflation, it does look like a bit from both the minutes and the dot plot that they did just that.
Right.
So it's not clear that they didn't overly bake or overly create a pretty high hurdle rate for 2025 in terms of rate cut expectations. The interesting part about tariffs, now I think that the Fed might have a different bar, because the last time they said the word transitory, it didn't in fact turn out to be transitory. But a lot of the research, both from the Fed and a lot of academic research, does suggest that many tariffs are transitory from an inflation perspective. They have a bigger potential to act like a shock than they do a permanent boost in pricing power. So if you think about Smoot-Hawley back in the 30s and even 2018, you did not see a persistent rise in the general price level of all goods and services. You certainly saw a rise in the price of washing machines and whatever else became privy to the tariffs. Right. But you saw what the rest of goods and services were in almost a decelerating or potentially even deflationary mode. Because if you are required to pay more for a washing machine, then unless somebody gives you more money, right, inflation is always and everywhere a monetary phenomenon, you will be able to spend less money elsewhere, which creates demand destruction in that area. So I do think that we're in for a unique setup in 2025, where the Federal Reserve sort of started off with a higher bar that we may not, in fact, happen. We may not, in fact, see. And maybe for the first time in 3 years, they cut more than the expectations are at the start of the year.
Really interesting, potentially adds to the bullish story that part of which you're painting right now. I am so delighted, maybe I'll speak on everyone here, that you look at the 1930s Smoot-Hawley discussions, because I've never heard of them, and I'm so glad that someone does. When we see corrections and just pushing through a shock within markets these days, and we've had lots of them of the last little while. There's this argument that markets are getting more efficient, or just they price it in. It's quite painful and harsh, but faster, and we move on. I'm just sort of curious if you can paint a picture for tariffs that way. Maybe it's a hopeful question.
Yeah, there is some math that certainly, I mean, let's just go to sentiment and then we'll go to tariffs.
Yeah.
Differently, it's funny because I just did a presentation, I think it was last month, on, hey, sentiment's really high. I know everybody's bullish, but here's the math behind sentiment indicators. They work well as a buy signal, meaning you want to buy stocks when sentiment is really poor, but they don't work very well as a sell signal, meaning when sentiment is bullish, it doesn't necessarily mean you want to sell stocks. So it's almost like an asymmetrical relationship. I can give you a positive correlation. I can give you a positive T-stat, but the truth of the math is it only really works one way. And one of the reasons why it works one way is because when you are, historically speaking, at top quartile sentiment indicators, what you have is usually a very quick reset. And this reset becomes quicker and quicker. So for the correction that we saw in the S&P 500 in December, what that was, I think it's a bottom quartile correction. What you have seen historically, if you chart it, is a larger and larger contraction in bullish sentiment. So people get spooked a lot more easily, and you can chart that. And the interesting thing about that spooked portion is that the more that resets quickly and the more concerned you are, the more uncertainty there is, the more interested I get in the stock market from a quantitative perspective. So when you look at tariff indicators, right? So I talked before about small business uncertainty, right? And for each higher level of small business uncertainty, you have higher and higher odds of a market advance. Like that is literally the definition of the wall of worry. The same thing is true for those valuation spreads that I talked about. The same thing is true for trade policy or monetary policy uncertainty, both of which you can measure. So trade policy uncertainty, I don't have it up on the screen next to me.
Oh yeah, you were mentioning this. Okay, so it was, there's a comparison to sort of the tariff trade uncertainty back in 2018?
Exactly. So I think the data set goes back to, and I'm going to put it in my charts of the week. The data set goes back to, I think, the 80s. And it generally was in a range of, let's call it 50 to 75, because there was very little trade uncertainty during that time. 2018, it spiked to about 175. And that was coincident with the trough in the market. The interesting part about what December saw was a spike to 350. Right. So I can't tell you, the data set has never been to 350 before. But what I can tell you is that this anomalous reading, again, sort of going back to that linear trend, the more uncertainty you see, the more likely stocks are to be higher, tells me that if you are afraid about trade policy, so is the market. Right. So you're there. And that is, for me, that is the big mathematical difference this cycle versus any other cycle.
Where that you can see it, like it's visible. Is that the?
Yes.
Okay.
Yes, exactly. You can see it, you can measure it, you can linearly relate it to correlated market returns. And all of this is very different from prior recoveries, right? We didn't actually have an official recession, and yet valuation spreads and fear are at recessionary wides. So I think that's the very big difference from me versus most strategists that say, hey, we already saw 20% up years in the S&P 500. You combine that with the fact that stocks are relatively expensive. Now they're expensive relative to bonds. Isn't it all priced in? I find none of those things predictive. In fact, I think that they work in the opposite way. The more the gains of the S&P 500 over the prior 2 years, the more likely the year of the third year is to be higher. So none of these are detracting. And while what I find is very different, all of these uncertainty measures of this persistent fear are still telling me that there's upside in the market.
And are recalling, take us to the animal spirits in the market right now. What actually is there, or what could be there over the course of the next little while? Because that often will drive the valuation picture, won't it?
No, that's a great point. And I do think that durable earnings growth is those sort of, I'll call it the animal spirits that we haven't seen yet. So it's funny, and I'm in the process of doing a white paper on this. Last year, what we saw was the vast majority of the gains in the market were multiple expansion. It was not really earnings growth. So that has raised a lot of concern, like it's fake, right? So it's not based on earnings growth. Now, look, we can look at the data historically. We have annual data going back to the 30s, actually quarterly data going back to 1935 in the S&P 500. And you can say, okay, let's look at situations where we had outsized multiple expansion driving the market instead of earnings growth. And then let's look at the next year forward returns. And what you find is markets are disproportionately likely to be higher. Why? Because earnings growth is disproportionately likely to be durable. And I think that's the big thing. Like, I can't guarantee you, but what I can tell you historically is when the market has gotten ahead of itself from a multiple appreciation perspective relative to earnings growth, it's actually been right. And mid-cycle earnings have been higher than you think, which creates less of a valuation headwind, which creates more upside for stocks.
That's absolutely fascinating because there's such a big question mark about. So let's sort of go to the other sectors themselves. Bank stocks have been fascinating. Towards the end of the year, you had the deregulation promise through President-elect Trump, and that created all kinds of, we'll probably call them animal spirits, but lots of hopes that there would be less on the regulatory front, and therefore they flew. They're also in a position, probably, if we have this 10-year sitting at a closer to 5% yield, just to have a better setup for lending, right? I mean, it's just a better overall picture for them. What else? Because banks, I think, are your number two. Is that right?
Yes, banks are my number two. I would say financials in general.
Yeah.
I mean, capital markets are also a positive risk reward, so I don't want to just focus on banks. But banks also offer a positive risk reward. I think it's the four factors that we've discussed before. I mean, the stocks are cheap. Relative earnings growth is at trough and has turned, which is usually historically positive. But what is different this time is that those valuation spreads are wide. So that's more reflective of that level of fear. And what's unique this time, to your point about the yield curve, conjoined with credit spreads, this is the sweet spot that we have not seen in over a decade.
Wow.
So credit spreads coming down, so the credit market telling you, hey, there's no bankruptcy or solvency issues, and the credit market is more often the smarter market. Couple that with the fact that interest rates are higher now, the yield curve is positive now. Both of those set up banks for better positive fundamentals going forward. So that like dual issue of higher rate or lower rates, lower short-term rates in terms of the Fed, and lower credit spreads has been the sweet spot historically speaking, and the uninverted yield curve. So you've got a really good amalgamation of quantitative factors that I think point to a very positive risk reward in financials, plus the deregulation story that I don't think is done yet. And I think that that's one of the big issues in the small and mid-cap story is to the extent that small and mid-cap banks do need to hold more capital, there will be less lending. And if there is less lending by them, that disproportionately hurts small and mid-cap businesses themselves. So that's been sort of the bifurcated economy, if you will. The larger your company has been, the more you're able to borrow in the broader market, and the more credit spreads have been tighter, but the lower in terms of your market capitalization or the smaller your business is, the more you are tied to lending from, overnight rates or shorter term rates that have been much higher. And the more you are likely tied to small and mid-cap banks, which have been hurt from a lending perspective.
Fascinating. So it's really interesting amongst all those different pieces hurt in the valuation area. So that'll be an interesting place to watch. So you've got consumer discretionary banks. Let's go to your other top, to round out the top three and then bottom three.
Yeah, so top three, I think you got to add technology. So I do think technology actually enjoyed its own valuation reset during December. And it wasn't necessarily because it underperformed, because it obviously did not. It was leadership. It's because earnings growth is still so strong. So despite the fact that technology outperformed, the stocks actually got a little cheaper. And we're out of that top quartile range, which changes your risk reward to be positive. And the interesting part about within it is that software specifically has been one of the more expensive sectors over the better part of the last 5 years. And now you're in the bottom half of the distribution when you look at either price to book or relative forward PE. Again, this is versus the overall market. And when you are in that distribution set, the bottom half of the distribution on valuation, much like consumer discretionary, you have a positive skew, regardless of whether or not earnings growth is positive or even if it's negative. So valuation historically has provided really strong support in software generally, and I would say technology as an overall sector still has that positive risk reward. So my top three, and I would say in no certain order, would be consumer discretionary, financials, and then technology.
And looking at the bottom three, the ones to stay away from, there's lots of people talking more about some of those interest rate sensitive areas. I mean, financials are one as well, but what pulls into the bottom at this point?
Yeah, so I would have to say utilities as one of the top ranked bottom sectors. And it's partly on the fact that utilities, and I don't know where we ended the year, but there was a point in time where utilities was the #2 sector in terms of, it was technology and utilities. And if I had a nickel for every time that a portfolio manager asked me, does this have any meaning that utilities are the #2 sector behind technology? Because it's an AI play, right? I would certainly retire. But I have to say that one of the biggest signals in utilities is you usually want to sell them after they've outperformed. So I do think that we saw a quasi-defensive rotation in 2014 of utilities, and in some ways technology is your best defense and offense at this point, much like consumer staples was in the 1980s. But I think that that's the interesting part about utilities, is that the fundamentals aren't any better when I look at the data sets, and valuation isn't, has actually appreciated over the course of the last year, and I think does set the sector up to underperform. So that would be data number one that I would push against. And yes, maybe it's different this time, but on regulated utilities, I don't think that they're the AI play that you're looking for. I'm not saying you can't buy any stocks in utilities. I'm sure you could find some power utilities, some more power exposed utilities that are quote plays on AI, but I think from an XLU perspective or an S&P utilities perspective, I don't think that the risk reward is particularly positive. Behind utilities, I'll pick number 2 and 3, which is energy and materials.
Okay.
So I still think that space, despite the fact that you do have valuation support, I shouldn't say support, let me use that word, you are at bottom quartile levels for valuation. I think specifically in terms of energy, there's still excess supply. Shales, as much as you want to say, there's going to be potential peaks in the shale resources over the course of the next year, I think that you're going to need to see that because excess capacity in other areas of the world with OPEC is still quite hefty. And that's the problem with markets, is that as much as you want to think that, well, if there's more demand, right, demand is recovering, maybe there will be a global recovery, and supply in terms of the shales are peaking, that means inventories are going to be lower, and inventories are going to create more pressure on price. The interesting part about the math of the market is it doesn't really work that way. Right. So inventories relative to average up or down only have 50% odds of telling you what price will do over the next year. What is always more important is excess capacity. And you can define that in terms of shale resources, or you can define that in terms of how much OPEC has already cut and that we know they can produce. And the reason is because markets are pretty smart and long-term focused. It's not just clearing inventory over the course of 1 year, but when that sort of price increases to that level, those barrels are going to come back on the market. That caps your upside potentially and skews your risk reward lower. So I think that that's the energy story that exists despite the fact that the stocks are still, and I'd have to look currently, but the stocks are still pretty cheap. I think until you get back down to below median operating margin or return levels, and we're not there yet, that's when your risk reward for energy might change. And material stocks just have a perennial problem in terms of how much they spend on free cash flow.
Right. So we have to leave it there. I'm so sorry. We have to go to what is kind of breaking news, but that is also the put that you have discussed, or the stimulus, really, that's also sloshing around in the market.
The stimulus.
That makes it all work. Denise Chisholm, we're ever thankful for your insights. Thank you for joining us here today on Fidelity Connects. See you soon.
Thanks.
Denise Chisholm joining us here. Now, before we end today's show, we'll bring you a timely insight from Peter Bowen. He's Fidelity's VP of Tax and Retirement Research on what happens next with the proposed capital gains inclusion rate, the increase in Canada that was announced back in the spring, now that Parliament has been prorogued. Take a listen.
Hello, I'm Peter Bowen, VP of Tax and Retirement Research at Fidelity Investments Canada. On January 6, Parliament was prorogued until March 24. This has created a lot of questions about tax legislation. When Parliament is prorogued, legislation that has not yet been passed, which includes the increase in the capital gains inclusion rate, is terminated. Some articles have stated outright that prorogation has killed the change, but that isn't necessarily correct. When Parliament reconvenes, it is possible that the legislation could be reintroduced and passed. I'm not suggesting this is likely, but it is possible. Further, CRA confirmed again yesterday that it is continuing to administer as if the legislation were already in place. This is expected to continue to be the case even if Parliament is not sitting or in session, or in fact is dissolved. First, remember that individuals are only subject to the higher rate on gains above $250,000 each year. So this question isn't relevant for the majority of Canadians. But given CRA's position, we think that most taxpayers that are impacted will file on the basis of the higher rate being effective. Then, if the change never becomes effective, they will be eligible for a refund. Taxpayers can choose to file otherwise, although that brings some risk. If the legislation is eventually passed, they would be reassessed and potentially owe non-deductible penalties and interest. We've also received questions about dispositions that taxpayers triggered prior to June 25 last year to get ahead of the increase. Dispositions which they wouldn't have otherwise done. Unfortunately, I'd be highly surprised to see any relief available to mitigate the fact that those taxpayers are paying taxes earlier than they would otherwise have had to. Your guess is as good as mine, but I would think it's unlikely. It's widely expected that there will be one or more non-confidence motions once Parliament reconvenes, and the Liberals would need to survive those, then get the legislation tabled and passed. Again, this is expected to be unlikely, but we'll have to wait and see.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.